for two reasons. I like the name MACD. It's a little bit easier than saying moving average, convergence, and divergence. I like the title MACD. And it is one of my favorite ones because it's great to use and gives you a lot of information, unique information that's actually reliable. Now, in today's class, I'm going to use the term security, but I might say asset. I might say Facebook. I might say Google. I might say Bitcoin. I know I'm going to say the euro, but I'm not talking about any specific asset. I'm talking about all publicly traded financial instruments in which an open market exists. Similarly, I intermix the terms investing and trading. Typically, an investor takes a long-term position, while a trader takes a much shorter-term position. In either case, the basic concepts and techniques presented in this class are equally adept. Now, it seems like whenever I'm giving a presentation, I'm giving a seminar, I'm meeting traders on one-on-one basis, I'm at a conference. See, the first thing people ask me is, what should I buy today? What will the prices be next week or next year? Do you know how many people over the last 2 weeks have asked me about lemonade? Well, the fact is, if I don't trade something, I don't know anything about it. It's just like asking the guy on the street corner. Well, but wouldn't investing be easy if we knew the answers to all these seemingly simple questions? But I don't have a crystal ball, and I don't have a Ouija board, and I don't know anybody that does. So if you're attending this class in the hopes that technical analysis has all these brilliant answers to these questions, I'm afraid I have to disappoint you. However, if you're attending this webinar with hopes that technical analysis using MACD will improve your investing and trading, that I have good news for you. That it surely will do. So let's go on with moving average, convergence, and divergence. Now, a bit of history. The indicator was developed by Gerald Appel in the late 70s. Now, if we think back to the 70s, there was no internet. There was no online trading. In fact, in the 70s, it didn't exist, but it was illegal. There was, in those days, you had to only deal with a broker who you called on the phone, and each broker specialized in very small markets. We didn't really have computers. We had we didn't have PCs. We had these MS-DOS, green screen things, but that was it. And what did most people trade in those days? Now, in those days, I was actually a trader trading commodities in the pits in Chicago. But very few people traded commodities, and I traded agriculturals. Professionals did, but it wasn't something that an investor, speculator kind of did, especially individual people. And if you did, you were trading stocks. And MACD was developed for the stock market. And like a lot of indicators, even the stuff we learned from Dow and Dow theory and Charles Dow, they remain efficient and effective in slow-moving, slow-paced markets. And they work well for investing, but they don't work so good for trading. But MACD flowed over very easily and has become one of the most popular Forex online trading indicators because it adjusts quickly to fast-moving markets and works well in very short time frames. So the basic function of MACD is to discover new trends and help identify the end of current trends. And there are various ways to gauge it, but before we can gauge it, we have to understand the indicator itself. So let's go over to our live chart. Now, today we're going to go through every single line that makes up MACD. But after today, you'll never have to do it again because MACD, you just click on MACD indicator and it's all dropped on your charts for you. Now, what we're looking at is the Euro US dollar chart. Let's change it over to a 30-minute chart, too small of an area. This is my standard teaching chart. Now, on this chart, you see a lot of horizontal lines. Pay no attention to those, please, but I can't take them off because they're my levels of support and resistance from the past, and I need them on my charts for other classes today. And they're important to always have support and resistance on your charts. But MACD is an indicator of an indicator of an indicator. It's a 4-step derivative from price. So MACD starts out by using a 12-period moving average. That's pretty easy. So on our chart here, we have the gold line. That is a 12-period moving average. We know what a moving average is. It's a pretty simple piece of information. Everybody uses a moving average. And then we combine that with a 26-period moving average. That is our purple line on the charts. Now, if we were to use these two lines as an indicator, this is simply a moving average crossover strategy. It's a very simplistic strategy, and there's a lot of strategies based on moving average crossovers that use 10 and 20, 30 and 40 different time frames. MACD isn't a moving average crossover strategy. It's just using these two lines as the beginning point. And what MACD does next, it calculates the difference between the 12-period moving average and the 26-period moving average by simply taking this number here and subtracting that number there, and then it's plotted down below on our charts. That's this blue line. Actually, okay, we'll leave it here. That's this blue line down below, and that's known as the MACD line. Now, this MACD line is pretty simplistic. It is simply the numeric difference between the gold line and the purple line. It's between the 12-period moving average and the 26-period moving average. It's plotted down below on a chart with a center line of 0. Why? Well, if we take the 12-period moving average and subtract the 26-period moving average, if the 12-period moving average is higher than the 26-period, it's always going to give us a positive number. If the 26-period moving average is larger than the 12-period moving average, then we would get a negative number. So in other words, here are, let me just clean these lines off here for you. Here, our 12-period moving average is a larger number, and we're subtracting a smaller number for it, and therefore it is always over top of the 0 line. Over here, we have a different set of circumstances. The 12-period moving average is smaller than the 26-period moving average, and what happens is when we subtract one number from a number larger than itself, we're going to get a negative number. So that's plotted below the 0 line. Whatever the numeric value is, it's just plotted on this chart. Negative numbers under the 0, positive numbers over the 0. Now at this point, we don't need these moving averages anymore on our chart, because that is just the basic start point for MACD. So let's get rid of them. And now down below, we have our MACD line. I'm going to make this bigger and bolder so you can see it a little bit better. Okay. Now, that's one line. It doesn't tell us much. It does tell us about the 12 and the 26-period moving average, but that's all that it tells us. Now, I don't know if I can do this successfully. I'm going to try. I did it successfully. I didn't know if the system would allow me to do it. And that is, I put a red line on the 0 line on the charts. Or as close as I can get to the 0 line. Okay, so you can see the 0 line. That's just 0 plotted on the chart. Now MACD goes to the next step, and it takes a 7-period moving average of the value of the MACD line. So it takes the last 7 calculations of the difference of the moving average above, adds them together, and calculates that and puts that on the chart below. Now, this is called a signal line or a trigger line. When the MACD line and the signal line cross, they give us buy and sell alerts. So in other words, here we got a buy alert. Okay. Here we got a sell alert. Okay. If the trigger line is below or crosses below the MACD line, it's a sell alert. If the trigger line crosses above the MACD line, it's a buy alert. Now, one of the drawbacks of MACD is it simply tells you that there's an alert for a buy or sell scenario. It does not tell you how far that move is expected to go. It doesn't help you plot where your target point will be, where you put your stop loss, or where you should put your take profit. It doesn't even plot necessarily your entry price to the market. It's simply hitting you on the back of the head and saying here's a buy opportunity, here's a sell opportunity. Open your eyes and do some other types of calculations. But the alerts are very, very reliable. From here, though, we have more steps to the MACD. This is not the end of MACD. MACD then takes the difference between the moving average, between the MACD line and the trigger line, and calculates the difference and plots it on what we call the histogram. So what we have now below is this histogram or this chart of MACD, okay, of the difference between the trigger line and the MACD line. But what we can now automatically see is we don't have to worry which way they crossed, because what we see now is whenever we switch from a red to a green or a green to a red, they do that at the 0 line. And when it switches from a red to a green color or green line or moves above, we know we got a buy signal when it switches from a green to a red, because they're always at 0 when they cross. But it also helps us get a depiction of the market, how steep the move is. So it helps generate not only buy and sell signals, it helps generate overbought and oversold signals. A lot of us, especially myself, don't use any of these lines. We use only the histogram, because every bit of the calculation in all of those lines is here in this histogram that gives you a very, very pretty picture of what the market is doing. Now, for instance, when we got this extremely steep valley here, okay, in the histogram, we knew that the price had oversold. It shot way down, and it doesn't mean it's going to reverse back up, but it did reach into oversold territory. It could have gone into a flattened out long, but if I had been in a market in a sell position when I got down this low and then it started moving up a little, I would have looked at exiting the position. We can see that the trend is now reversing itself. And even though we got sideways action, okay, this downtrend was over. Okay, we get all of this from MACD. So what we have are a derivative of a derivative of a derivative of a derivative of a derivative. But again, you never have to do any calculations, because when you click on the MACD indicator, somewhere, somehow, okay, it will just drop it right on your chart for you. okay, with all of those calculations. Now, a lot of people are out there saying use a 10 and a 20, a 14 and a 92. You can customize MACD any way you want. But the fact is, it's no longer Pirot-Appel's MACD. And all the standard literature you read about it becomes not valuable because you've now made changes. Now, there's tons of discretionary literature in the markets about MACD advising you to trade this way or that way or this way or that way. You can use MACD in all types of systems. But first you have to understand, like we just did, exactly where the real MACD comes from. So now that we've seen it put on our charts and what these lines mean, let's go back to our PowerPoint a little bit. And let's try to understand MACD. Now, on most trading platforms, the MACD indicator typically comes with the default parameters of 26 and 12 and 9. 26 and 12 are the moving averages we started out with. 9-period moving average was the 9-period of the MACD line, which gave us the trigger line. And then the MACD histogram is simply an elegant visual representation of the difference between the MACD and its 9-day EMA. The histogram is positive when the MACD is above its 9-day EMA and negative when the MACD is below its 9-day EMA. If prices are rising, the histogram grows larger as the speed of the price movement accelerates and contracts as price movement decelerates. The same principle works in reverse as prices are falling. The MACD indicator is both a momentum oscillator and a price-based oscillator, and is one of the most reliable studies we have. While it is a lagging indicator, it works well in all time frames. So MACD gives us 3 stories, okay, or 3 popular ways to use it. We have crossovers, we have overbought and oversold conditions, and divergence. Now, divergence is one of the things I don't use anywhere, but I also don't use it on the MACD, but we'll touch it a little bit. Now, crossovers. The MACD crossover involves the interaction between the 2 MACD lines. The MACD line is faster than the signal line, and it would typically cross above and below the slower signal line. When it does, it will give us a bullish crossover, which is a buy signal, or it will give us a bearish crossover, which is a sell signal. So the bullish MACD crossover, we have a bullish MACD crossover when the MACD line crosses the slower signal line. The action generates a bullish signal on the chart, which implies that price might start an increase. Bearish MACD crossover is the exact opposite. So one of the best uses of the MACD study in Forex trading is the identifying divergence signals. Like I said, I don't use them. When the general price action on the chart and the MACD direction are in contradiction, this clue gives us a clue that price is likely to change direction. In other words, price is declining while the MACD gives us bullish divergence. Okay, now I don't see it, but see, if you drew your line underneath the MACD line and the MACD line is raising, okay, over the period while the price is declining, is telling you they're out of sync. Okay. Lots of people trade divergence on lots of indicators. But like I said, my eye doesn't recognize this divergence, and so I don't use it. But MACD overbought and oversold indicators are great. The MACD is also useful as an overbought or oversold indicator. When the shorter moving average pulls away dramatically from the longer moving average, it is likely that the symbol is overextending and will soon return to more realistic levels. So in other words, when the MACD line and the trigger line start to separate dramatically, what happens when they do? On the histogram, it gets wider and wider and wider. Now, many people don't know this about the MACD indicator, but the MACD indicator can also provide overbought and oversold signals as well. Overbought MACD. The MACD is overbought when the MACD line gains a relatively big distance from the signal line. In such cases, we expect the bullish move to exhaust after the strong increase and a bearish move to appear. Now, I'm going to share with you a little presentation on building a trading strategy using other indicators along with MACD and how you would interpret what the market is telling you using them together. So hold on, let me share that with you, and then we'll come back and talk about other ways to use MACD.
Indicator 1, RSI. The relative strength index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals such as MACD crosses. Indicator 2. MACD. The moving average convergence divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter term moving average is above the longer term moving average, this area of the indicator will show activity. When the shorter term moving average is below the longer term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market, and may use it as a signal to exit a trade. Indicator 3. Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of the time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4. Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red. Wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5, Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. You can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the super trend indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the super trend indicator to change red here before taking the short trade. So now we have the confluence of 4 indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the super trend turning back to red.
Now, I did mention that MACD doesn't help us really to place stop losses, targets, and exit and entry points. And you should never trade without a stop loss, even from the get-go. So when you open a trade using MACD analysis, you will want to protect your position with a stop loss order. To place your stop loss order effectively, you should refer to the chart for previous price action swing points. If you're opening a long trade, you could place your stop loss below the previous bottom on the chart. If you trade short, then you could place your stop loss above the previous top. If the price action creates a lower low on a long trade or a higher high on a short trade, your position will automatically be closed. One way to exit a MACD trade is to hold it until you receive the opposite signal. So a contrary MACD signal would be your signal to close out your trade. However, there are many other ways to manage your trade based on personal preferences. But remember, MACD, a MACD histogram, is a derivative of a derivative of a derivative. The MACD histogram is an indicator of an indicator. In fact, MACD is also an indicator of an indicator. This means that the MACD histogram is 4 steps removed from price. In other words, it's a 4th derivative of price. The first derivative, what? The 12-day moving average minus the 26-day moving average. And that gives us our second derivative, which is the MACD line, is what we plotted below. The third derivative is the MACD signal line or the trigger line, which is a 9-period moving average of the MACD. And then the fourth derivative is the MACD histogram, which is the MACD less its signal line plotted on the histogram. The base for this indicator is, of course, the asset's price. It takes 4 steps to get the actual price to the MACD histogram. So I want to talk about massaging data. While not necessarily a bad thing, chartists should keep in mind when analyzing the MACD histogram, it's an indicator of an indicator. Therefore, it is designed to anticipate signals in MACD, which in turn is designed to identify changes in the price momentum of the underlying asset. Now, traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets, because relatively small movements can cause the indicator to change direction quickly. The large number of false signals can result in a trader taking many losses. When commissions are factored in this equation or spreads, the strategy can become very expensive. So this is why we want to combine MACD with other indicators. Remember, I said to you in the beginning, it doesn't give you buy and sell actual signals. It gives you buy and sell alerts. It's like hitting you on the back of the head and saying, here's an opportunity. But you have to analyze that opportunity now that you're aware of it to make sure that it's worth trading. Because like I said, it can give you a buy 1 second and a sell the next second. Now, both would have been completely correct because the market went up and then it came down, but it wasn't enough for you to make profit. So the MACD indicator is the most popular tool in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. The clear transaction signals help minimize the subjectivity involved in trading, and the crosses over the signal line make it easy for traders to ensure they are trading in the direction of momentum. Very few indicators in technical analysis have proved to be more reliable than MACD, and this relatively simple indicator can quickly be incorporated into any short-term trading strategy, as you saw in our presentation. The strength of the current trend can be measured by channeling the MACD. You can spot trend reversals by looking for divergence in the MACD and determine buy and sell signals using the MACD crossovers. Okay. Learning to implement and recognize these signals help investors increase their profits when trading in short and intermediate trends. But the basic rules for trading with MACD indicator are: consider long trades when you see a bullish MACD signal. Consider short trades when you see a bearish MACD signal. If you are long, you should put a stop below the earlier bottom on the chart. If you trade short, you should put a stop above the earlier top on the chart. Hold your trades until you see the opposite MACD signal or until your stop is hit. But remember, life happens. Trading is rarely black and white. But MACD is one of the most reliable indicators. Now, if you look on your screen, there's a little section that says handouts. I've put together 2 handouts for you. The first one's called the MACD Indicator Guide. Okay. It's just a guide I put together with all the charts and everything else that we covered in today's class. It's yours free. There's nothing you have to enroll in, nothing you have to sign up for. Just click the download button and it'll download the PDF directly to whatever device you're using, and then you can move it around later because it's only available in this live class. I've also given you the technical analysis guide from investing.com. This is a great resource guide. It covers the entire field of technical analysis. So it's a very large encompassing guide. Okay. Download it, use it for your reference and your resources and everything you want. It covers every bit of technical analysis, from reading charts to trend lines to support and resistance to candlesticks to everything that fills in the field of technical analysis. So please click on the buttons and download them now because they're only available in this live class. And thank you very much for joining us. And if you do have any questions, if you go to www.legacyfx.com, use their live chat button. They'll be glad to answer them for you, or they'll make an arrangement for you to talk to a financial analyst or an educator on a one-to-one basis. So again, thank you for joining us today, and good luck in your trading. Bye now.